The Federal Reserve's upcoming meeting on September 17 to 18, 2024 will be one of the most anticipated events for many. The central bank has been navigating a delicate balancing act, curbing inflation without triggering a recession. After a year of steady rate hikes that brought the federal funds rate to a range of 5.25% to 5.50%, the Fed paused in mid-2024 to assess the impact of its monetary tightening. The Fed's primary focus remains on bringing inflation down to its 2% target. While inflation has cooled from its 2022 highs, recent data shows it remains sticky, particularly in core sectors like services and housing. However, the overall economic picture is mixed. Job growth has decelerated, consumer spending is weakening, and the manufacturing sector is contracting. These indicators suggest that the Fed's rate hikes are starting to bite, raising the possibility that further tightening could push the economy into a recession. At the September meeting, there is a growing expectation that the Fed may pivot towards rate cuts. Market participants are pricing in a 65% chance of a 50 basis point cut and a 35% chance of a smaller 25 basis point reduction. This shift is being driven by signs that inflationary pressures are easing, particularly in energy and food prices, and by concerns over the economic slowdown. One of the key risks the Fed faces is the global economic environment. The US dollar has strengthened significantly as a result of higher interest rates, making American exports more expensive and putting pressure on trade balances. Additionally, other central banks around the world, particularly in Europe and Asia, are facing their own inflation challenges, which could complicate the Fed's decision-making process. The Fed will also need to consider the impact of its policy on financial markets. Higher interest rates have led to tighter financial conditions, with stock markets showing increased volatility and bond yields rising. These factors have the potential to amplify the economic slowdown. Particularly, the Fed's actions are perceived as too aggressive. In addition to interest rates, the Fed's strategy for reducing its balance sheet will be a critical topic of discussion. The central bank's balance sheet expanded significantly during the pandemic as it bought bonds to support the economy. Reducing this balance sheet, known as quantitative tightening, could drain liquidity from financial markets, with significant implications for asset prices and economic stability. Powell has emphasized that the Fed will do whatever it takes to bring inflation down, also that it is aware of the risks of tightening too much. The Federal Reserve's September 2024 meeting will be a defining moment for U.S. monetary policy. Whether the Fed decides to cut rates, hold steady, or signal future moves, the outcome will have far-reaching implications for the economy, financial markets, and everyday Americans.